starting with the employment outlook. We've got some annual wrap up that we can talk through, and then talk through also RCLCO Fund Advisors near-term outlook for how this will develop over the next couple of years. So through 2025, employment growth slowed quite meaningfully and ended the year at just under 600,000. So a pretty steep drop off from the last couple of years, which saw outsized employment growth. The chart here shows both monthly in the column charts here, and the purple line shows trailing 3-month average. So as you can see, the trailing 3-month average growth peaked in January at the beginning of the year and has pretty steadily declined since then, ending the year at a trailing 3-month average of negative 22,000. Now, I'll point out that the October, November, and December figures there will be biased downward by the government shutdown in October, which pulled down monthly job growth among public sector employees quite notably. So apart from that, it seems that employment growth remains positive, albeit slow. Looking at the unemployment rate, we've seen a parallel trend in unemployment rate ticking up modestly. Again, it came in at its lowest rate in January and increased slowly but relatively surely throughout the year, ending at 4.4%. This is still a very healthy unemployment rate, and is consistent with what we're seeing continue to play out in the labor market, which is this no hire, no fire type of scenario. So looking forward for the near term, the next couple of years, we expect more modest employment growth to continue. That is partially a result of the slowing population growth that we see in the US. So that, of course, trickles down into the labor market. We also expect the unemployment rate to remain quite favorable, though, a sub 5% unemployment rate over the next couple of years. I'll note, though, that there will be some differentiation underneath that headline figure. So we've seen some of this already in the difficulty that recent college graduates are having in finding jobs. That's a byproduct of this no hire, no fire type scenario that we've been in. So some softness in the labor market, but at a headline, the summary statement is bending but not breaking. Turning then to inflation, some more pretty good news. Inflation, all items, CPI, ended the year down 20 basis points at 2.7%. Core inflation also ended the year down by an even more significant 60 basis points, down to 2.6%. So still trending above target, but an improvement over the last few years of elevated inflation that we've seen. Now, as I'm sure most people are aware, CPI peaked earlier in the year in response to the tariff increases. But since then, inflation has begun to moderate again, which is a trend that we expect to continue playing out. Looking at the components, I'll call attention to a couple of things. Number one being the moderation that we saw in services and core services. The largest component of those core services is shelter, which continues to grab a lot of headlines, but notably, shelter CPI has cooled from 4.6% last year to 3.2% in 2025. So good news on that front. This is something that economists continue to say this was the steady drumbeat throughout 2025, is that shelter CPI will turn around and will start to come down. But that of course lagged some of the market rents, market prices that we were seeing. Non-shelter services also came down notably from 4.2 down to 2.8%. And then core goods and food are the two components most at risk of tariff increases. And that did play out in the CPI numbers. Core goods, which actually saw price reductions in 2024, returned to some modest inflation in 2025. So we expect that breakdown to continue, with inflation being less driven by shelter and other core services, and goods and food playing a more meaningful contribution to inflation over the next couple of years. That said, we do expect the headline number to settle in that 2 to 2.5% range over the next couple of years. Turning then to interest rates, the big story of the last couple months as we ended the year of 2025 and started into 2026 was this normalizing in the yield curve. So the line chart on the left here shows pretty clearly that starting in December, the 10-year to 3-month U.S. Treasury yield spread began to widen again. That was after that was after several months of them nearing parity, and then even earlier in 2025 and 2024, seeing an inversion where the 3-month yield was higher than the 10-year yield. So this is a healthy sign in the bond market, and we expect these normalized spreads to maintain. I'll note that the 10-year outlook looks fairly sticky. So we do expect rates to remain at about their current level, somewhere in that 4 to 4.3, maybe even nudging up toward 4.5% over the coming years, even as we believe short-term rates will continue to come down, albeit at a slower pace. So the Federal Reserve, of course, held the Fed funds rate steady in its January meeting, and we expect them to proceed very cautiously with any future rate cuts. Finally, I'll mention consumer sentiment, which continues to hover near its all-time lows. Down at the reading of 54 is its most recent reading. Its long-term average since 1990 is 84. This is a lower number than we were at even during the pandemic. Obviously, the pandemic saw a significant drop in consumer sentiment, but lately these figures have been coming in very, very poorly. So this is a deterioration from last year, which saw a little bit more optimism on the part of consumers with somewhat higher survey responses here. And 2025 saw a meaningful deterioration in that. It started with some of the tariff concerns and their effect on inflation. It's driven by continued concerns around higher base prices after several years of higher inflation. And then the state of the labor market is another contributing factor that survey respondents have pointed to as an area that's causing some heartburn. So I won't deign to forecast what will happen with consumer sentiment, but I'll just note that the backdrop is fairly stable on the hard numbers, although the consumer surveys are telling us that that's not necessarily playing out in the softer data.